The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
You are watching The Trade here on AusBiz. Let's have a look at what traders are watching out there. In fact, I should say, US President Trump threatening Mexico with sanctions and tariffs in a dispute over water sharing between the two countries, accusing Mexico of breaking an 81-year-old treaty and, quote, stealing the water from Texas farmers. Japanese Prime Minister Ishiba is setting up a task force to oversee trade negotiations with the US, headed by his close aide and economic minister, who domestic media say hope to visit Washington next week. New analysis by the Centre for Automotive Research has found that Donald Trump's 25% auto tariffs will increase costs by about $108 billion for automakers in the US this year. And gold prices, of course, amidst all the uncertainty, racing to all-time highs, supported by recession concerns as escalating tariff tensions between the US and China fuel investor demand for safe haven assets like bullion. Oil prices, though, settling more than $2 per barrel lower, wiping out the last session's rally as investors reassess the planned pause in tariffs. Let's get into the technicals with Ilya Spivak from Tasty Live, who joins me now. Ilya, good to see you. I mean, what a week. Blistering one-day swings on the S&P 500.
Very good to be here, Juliet. And yes, indeed. Selfishly, for those of us that are inclined to trade in macro volatility, this is sort of like Christmas early, but it is absolutely shocking, some of these swings. I mean, of course, just a few days ago, we had the biggest rally in the S&P 500 since the first day off the COVID lows in late March of 2020. And already today, we're looking soggier and coming back. The aggression of the moves is obviously great, but if we take a look at the chart here, we can see it's actually been quite orderly around some of the key levels you might expect. In fact, that hold just above the 4,800 level lines up very nicely with where the highs were in 2022 before that rate hike induced sell-off. So the markets are seeming to respect familiar technical boundaries, and the surge running into the bottom of the range before Liberation Day at 55 there just a little bit about, and recoiling right there. So I think if we look past the aggression of the swings, what we have is a stair step down, a downtrend by any classic definition, lower highs, lower lows. And that makes for a path of least resistance. I don't think it's any surprised that the markets were so upset with Liberation Day, because of course the issue has not been tariffs, it's been the uncertainty of the rollout of fiscal policy in general. If the markets were afraid of tariffs, we would have seen this consternation back in November. They only started to really get this worried when all of the uncertainty around the rollout started to show up in business and consumer confidence data, like the PMIs, for example, and became a growth scare. And once it became a growth scare, that's when we got a sell-off. None of the reprieves we've heard that gave us the shocking rally this week off the lows really changed that whatsoever. We have now 90 days for more uncertainty. And then after that, maybe another. And then after that, maybe another. What the markets want is a runway that's forecastable. And they're not getting it. So all of the implications of that uncertainty as a dampener on economic activity, those are all here. None of it is different. We've had a little bit of a relief sentiment-wise, clearly, but the trend is still very much pointing lower.
What did you make sense, or how did you make sense, I should say, Ilya, of what we saw in the bond market, and what is the 30-year telling us?
So this has probably been one of the biggest head scratchers for people watching the macro this week. Obviously, Monday kicked off with an absolutely blistering sell-off in the bond market. And we have the weekly chart here, that big red candle you see, that's this week. Obviously, last week was a different story. Bonds were rallying. and they have been rallying since the beginning of the year around the idea that all of this consternation and the dampening effect it's having on economic activity is going to lead the Fed to cut rates sooner and perhaps more aggressively. At the start of this week, we were looking at maybe as many as 6 cuts between this year and next. Obviously, last week we had a really big bond rally on that basis. And so this week, when the news didn't get any better or different, this massive sell-off certainly caught people off guard. And I think it really all comes down to a relatively simple explanation. There were a lot of theories out there about maybe China is selling, which doesn't really make sense because the dollar wasn't collapsing at the same time. It's only really started to come off now. We had stories about maybe the basis trade unwinding, and there's probably something there that accelerated the move, especially with some big liquidations in Japan. Or at least that's the rumor mill. But the story is, I think, much easier. We've had a massive amount of uncertainty, and what that has started to look like is wildly higher term premium across the entire curve because the market simply does not know where things are going and wants to be compensated for duration. So if you look at the level of selling in, let's say, the front end, the 2-year, it's not very significant. And the further you go up the duration scale, the further you go out on the yield curve, the crazier the selling. Now, we've arrived, it seems, at a very important juncture here. When the pain in the bond market was at its greatest this week is when the president decided that he was going to give the market some relief. In other words, there seems to be a Trump put after all. It's just not in the stock market, it's in the bond market. And so we're looking at some key levels here, seemingly, where we've arrived at where the trend started at the beginning of the year and where sort of the series of higher lows stretches all the way going back to late 2023. If we start to get the sense that there is, in fact, a response to market discipline, and the markets start to understand that, and we start to get a little bit more evidence that the recession that we're increasingly seeing is gathering, and the Fed starts talking more vocally about rate cuts, even if we start to get the economic data that shows it, like, for example, CPI and consumer confidence tomorrow, I suspect bonds actually start to rally back from these levels.
What about what we're seeing in currencies, Ilya? I don't think I'm coming to the US anytime soon to visit you because I can't afford it with where the Aussie is, but the euro US dollar, very interesting moves.
Absolutely. And the Aussie has helpfully stormed back. So maybe a little bit of relief there. But the euro is absolutely scorching. And what we see here is what is maybe the beginning of a much more significant advance. We're taking out levels that we haven't seen tested since late 2023 and approaching that major range top just above the 115 figure. That's the high from mid 2023. This seems to really be all manner of things coming together. Obviously, we've seen U.S. stocks and bonds fall in tandem. That's an exodus from USD-denominated assets amid all of this really sovereign uncertainty, if we think about it in simple terms. But of course, also Europe is about to spend a lot of money on defense. And that's going to be inflationary. It's going to create a lot of economic activity. There's going to be a lot of money sloshing around in the Eurozone next year and in Europe more generally. And that probably means that there is much less scope for rate cuts from the ECB beyond whatever they're going to do this year. In fact, the markets are already flirting with the idea that we're about a 50-50 shot away from a rate hike from the ECB next year. So the yield differentials are shifting very much in the euro's favor. And if we can take out some of these near-term levels, we're looking at what could be a really structural euro rise with 120 and above in the crosshairs.
All right, Ilya, always good to chat. Have a great weekend. Thanks so much, Ilya Spivak from Tasty Live. That does it for this edition of The Trade. Be sure to join us next week.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.